The turtle trading experiment was a really famous study which was done in the 1980s by a world-famous, world-class trader, Richard Dennis. And it was such a popular experiment because it tested to see if you could take ordinary people and teach them to become good traders using a mechanical set of rules. And this was frankly one of the first ways of algorithmically trading, and it really showed how mechanical trading processes can be super effective. And this book, The Complete Turtle Trader, was written quite a few years later in 2009, but it was written by Michael Koval, who went and documented the actual experiment and did research to see what exactly the traders did. So in this video, I'm going to take the strategy which these people used to become successful traders, code it, put it in a MetaTrader 5 expert advisor, and then see if the same strategy still holds up today in today's markets relative to those of the 1980s. So I encourage you guys to buy this book and read it because it's really interesting. But the general premise for some background is that Richard Dennis was a commodity trader based in Chicago, and he was an old floor trader who then made his way to being more of a position trader. And like many other commodity traders at the time, he was a trend follower. And what trend following is effectively you try to enter a position when the market is about to begin trending, and you hold it until the trend reverses. And typically it's a very low win rate, very high risk reward system. So you take many frequent losers because you are constantly trying to enter when there might be a breakout, or there might be a moving average crossover, but your wins tend to be enormous, and they often pay for many, many losers. And this particular type of system of the multiple day, multiple week trend following worked exceptionally well in the 80s and late 70s, just because many different commodities trended heavily. This was a time of relatively high inflation, lots of central bank manipulation of, or not manipulation, of controlling of different currencies. And at the same time, we also had kind of a lot of privatization going on. So many commodities were previously under price controls, like plywood used to be under price controls. There was a lot of focus on agricultural commodities because the Cold War was in full swing. So essentially, as markets were changing heavily, we quite often saw these massive trends emerging. And that's one of the reasons why Richard Dennis, as well as many other people, just made a tremendous amount of money during this particular time period. And it was a very simple trend following approach which made this possible. So not to go too much into the weeds, but I actually have the book in a different tab right here. And there's a lot of different nuances which they taught the people, but fundamentally there was two different strategies which were the bread and butter of what they were trading. And the first strategy was essentially, or both strategies were just breakout based systems. So in the first strategy, that was the shorter one, you would essentially buy on the breakout of a 21-day bar high. Or alternatively, if it was a short, you would sell on the breakout of a 20-day low. And what that means is that essentially that's the 1 month high. If you break above the 1 month high, or in terms of, that would be like 20 trading days as its business days, buy. And then to close your positions, what you're doing is that at a 2-week low, so once you hit a 2-week, you do a breakout to the other side of 10 bars or 2 weeks, that's when you exit the position. So that may have been a fairly convoluted sentence, but what I'm trying to say is that if you take 20 daily bars and you're looking to go long and you breach the high of those 20 daily bars, go long. And if you take 10 daily bars and you're in a position and you go below the low of those 10 daily bars, exit. And that was the first strategy. The second strategy was very similar, except it was more of a swing trading approach. And that was a 55-day high, and I believe a 2-week, but don't quote me on that, short. It should be saying that here too. Oh, 20-day exit. There we go. So 55-day, and then to entry, and 20-day exit. So 4-week. Perfect. So those are the two different strategies. And the other critical element here was that they would average into positions. So there'd be a pyramiding aspect in which they would essentially let me see if I can find that here, they would essentially be constantly adding additional units as price went in their favor. So many traders like this approach, and it's actually an approach done by many good professional traders, is good traders don't average into losers like a grid martingale would, they average into winners. So as price goes more into your favor, you adjust the stop loss to be essentially take risk off the table, but then you're adding more additional units of risk in. So one thing that these guys did here is they also did do a pyramiding approach where they would constantly add into winners so that if they were to have a massive trend, they would have multiple positions riding into that trend, close them all simultaneously, and make a very good profit. So I ran a few different tests here, but the first test I did was the simple strategy one. So I looked for, with the exact same rules which they were doing, essentially buy on a 20-day breakout, a 20-day daily bar breakout, and close at the breakout to the other side of 10 days. I also allowed longs on and shorts on, and we essentially just are buying at the market open here. So nothing too crazy. So we're buying at the beginning of the day. And here I was risking 1% balance risk per trade. Oh, pardon me. Another really important thing is that the stop loss which they were using, so we already spoke about the take profit system, but the stop loss which they were using was simply an ATR. They call it N, and it's calculated in a slightly different way, but for all intents and purposes, it's just an ATR. And it's a 2 times ATR stop with a 20-period ATR. So that was the mechanism they were using for stop loss. So trigger, break above, breakout of highs, so a very simple Donchian channel. The exit would be a break below 10-day low, and the stop loss here would be a 2x ATR, this being a 20-period ATR. So guys, this is a more technical video, so if you are not following something, please just drop me a comment. I can go more into the details. And essentially what we see here is I ran a back test. I actually used 1 minute open, high, low, close, because with these big swing systems, using every tick is not always relevant. Like, I've done both, they look very similar. And essentially I did this from a 5-year period because you're not going to see too many trades. So here we can see the results of the back test, and as we can see, it's not that spectacular. It's essentially moving sideways, and then as gold has been trending the past few years, it got significantly better. But really, this shows that this basic system, when applied to a CFD broker, is not that spectacular at the moment. But the first thing I did was actually see what would happen if we only took longs. And obviously, this is not best practice for system development. This is because we know that gold has been going up and up and up the past few years. Therefore, if you only take longs, you are almost guaranteed to significantly improve your equity curve. But obviously, that is incorporating a look-ahead bias. So don't do that when you're developing trading strategies. But it was more just to illustrate what would have happened had we been able to detect the bullish market. And as you can see, it is more profitable, but at the same time, it's not amazing. And if we look here in the back test, one of the big reasons for this, and why if this type of strategy is still widely used today, but it's not used on CFD brokers, and that is largely because here a significant percentage of our profit is being taken away by swaps. And ultimately, CFD brokers are phenomenal for intraday trading, but often are quite expensive if you want to do more longer term period trading. So here we are seeing a profitable system, but I would venture that swaps are cutting out a pretty hefty percentage of our profits. And we're running this in the daily chart. So as you guys can see recently, this is very much a classic trend following system. We have many small losers, but as gold does well on a breakout of a 20-day high, we enter and we wait for a retracement on a 10-day, and that's how we exit. So this is how the strategy has been doing recently. And obviously with the recent very, very bullish rally in gold, we've been seeing quite a bit of success here. However, do know that this does require a fairly strong trend to work. Okay, so the first trial was obviously not ideal, so I was thinking to myself how we could go about improving this strategy for today's current market environment. And I tested a few things essentially. The first of which was I thought it might be beneficial to use a tighter stop loss in order to get us out of the market faster. It's one of the big issues here is that as we could only enter new trades if we had no current positions open, that made it very challenging because we only were trading a handful of times per year, and it didn't make it super statistically significant. Second of all, as we're trading with CFD brokers, the longer we have to hold trades for, the greater the impact of spreads on our positions can be. So essentially, I switched from using a 2 times ATR multiple to a 0.5 times ATR. I kept the same length as well as the same actual trigger to enter the position of entering on a 20-day breakout. So the exits here change, but the entry is exactly the same. At the same time, the next thing I tested was, instead of using a breakout-based exit, I prefer to use a trailing stop loss, because that means that we essentially follow price as it keeps going, and that enables us to ride it, but also like not be stuck into the trade once it starts to turn against us for too long. So here essentially I did a trailing stop loss based on the size of the initial stop loss. So what I'm saying here is that, hey, if our initial stop loss is 0.5 ATR, we are going to start trailing at 5 times that. So that would be 2.5 times ATR. And we're going to trail by the same amount as the stop loss. So the same premise holds true. With trend following, we want to have massive risk reward, and we would likely also accompany that with a fairly low win rate. So that is also holding true here. One thing to note as well is that I am only going long, and I said recently that you have to be really careful when doing that because you can easily overfit. And that's why I will go and discuss this COT report fundamental filter, which kind of justifies why I'm doing that later, and why I personally like to usually make these types of swing systems long only. And yeah, so running that back test here, obviously this looks much better, and we are turning $10,000 into around $24,000 over the span of 5-ish years. So not anything astronomical, but still a very, very good return. And one thing to note is that the biggest qualm that I would have here is that if you only go long without a stronger rationale for doing that, and that's one of the reasons why I have this COT filter added to it. And if you're familiar with my bots and our bots at Prosperity Algo, I love using the commitment of traders reports data to essentially inform us if we're in a bullish or bearish market. And essentially we just ride the coattails of some of the smartest money managers in the world. And what I did here is that we're only going to allow this bot to run if we have a net long positioning amongst large speculators. And why that is important is essentially if the market thinks that the market is no longer bullish, we won't enter. And that can help to alleviate, at least in my opinion, some of these biasy points. And in some of my other bots, I've actually run this on bearish periods too, just to ensure that the COT report keeps us out of bearish periods. And essentially, if you're running a long-only bot, obviously it's going to work super well during bullish periods, but you want to make sure that it also works during bearish periods. And that's what the COT filter aims to help us with. And as you can see here, with the COT filter, we take fewer trades because we have these periods where we stay out of the market, but our equity curve is still looking really, really good. And then the final thing I tested was actually pyramiding. So when I had the book up, I was showing that we can also scale into positions using pyramiding. So once we bank a certain R in profit, we will enter more positions, and then we essentially close them all together in a grid. And I tested this as well. It was quite a complex coding challenge, but ultimately it also works. So let me go to the H1 so that we're able to see this bad boy work. And as you guys can see, as we bank 1 R in profit, we keep opening new positions and then they all close together in a grid. So it's like a positive grid as opposed to a grid martingale. So here this would be like 1 stop loss worth of distance, so 1 R. We then open another position, we wait 1 R, but then the trailing stop loss closes us here. And it's the same approach. This would be a really good example of 1, 2, 3, 4, 5, 6. Boom, close. So this was the effect of using more of a pyramiding approach. So I tested that from the traders, from the turtle traders as well. It does work, but it does not work nearly as well. So my approach, from a risk management perspective, unless I'm missing something, I would definitely go with not using pyramiding, but instead using a fundamental bias. So guys, hope this was an interesting video. It was a pretty long one today, but my takeaway is that trend following is still a phenomenal strategy in the current market environment. Just we have to be mindful of a few things, that the trends don't tend to be as long, but at the same time, our trading costs are so much lower that we can afford to get in and out of the market pretty quickly. Your spreads in 1980 and your commissions in 1980 were like many multiples higher than they are today. And that's why they had to be in the trend for a super long time just to be able to cover their basic commissions and spreads, etc. Whereas with us, we can like get in and out within milliseconds, right? Or fractions of milliseconds. So I'm kind of adapting this that we're still trend following, but everything is shrunk a bit because our transaction costs are much lower. I also love adding a fundamental filter here just to make it a bit more robust. But yes, there's definitely something here. The same strategies, there's type of strategy of like channel breakouts, trend following, definitely viable. Just needs a bit of tweaking to be CFD and current market environment appropriate. Hope you liked the video. Have a great day and see you in the next one.